Hi everyone, welcome to Charts and Perspectives, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an Economic and Market Research Analyst for TMX VettaFi. Today we're breaking down the Federal Reserve's first move, or rather non-move, of 2026. Let's dive into the charts and see what the latest FOMC decision means for the markets. First, a quick refresher. The federal funds rate is the overnight rate banks charge each other. While it sounds technical, it's the master switch for the economy. When this rate moves, everything from your mortgage to corporate bond yields feels the ripple effect. The FOMC kicked off 2026 by holding rates steady in the 3.5 to 3.75% range, keeping the rate at its lowest level since 2022. This is a strategic pause after 3 consecutive cuts. The why behind the decision is simple. The Fed has entered wait-and-see mode. Officials want to ensure that the previous cuts have time to work through the economy without reigniting inflation, which remains slightly above their 2% target. Basically trying to balance a cooling labor market against persistent price pressures. The market saw this coming. Expectations were sitting at over 97% going into the meeting. So the real story isn't the decision itself, but the why behind it found in the press release. The Fed operates on a dual mandate. Maximum employment, and stable 2% inflation. Right now, they're walking a tightrope. On the jobs front, gains have remained low, and unemployment has shown signs of stabilization, at levels last seen in late 2021. On the inflation front, the Fed still calls it somewhat elevated. Though we saw headline inflation cool in December, the Fed is wary of sticky prices that haven't yet reached their 2% goal. Essentially, the Fed is facing a cooling labor market and stubborn prices simultaneously, making their next move a difficult call. The committee stated they're prepared to adjust their stance as appropriate if risks emerge that would impede their goals, and they'll continue to take into account a wide range of info, such as readings on labor market conditions, inflation pressures and expectations, and financial and international developments. Given this guidance, how is the market interpreting the Fed's next moves? According to the CME FedWatch tool, the market is currently pricing in 2 25 basis point cuts later this year, specifically in June and December. However, keep in mind these odds shift in real time with every new data point. While we didn't get a new dot plot this meeting, the December projections show the committee expects a gradual path down toward 3% in the long run. You can see the phantom dots widening in later years, which tells us there's a lot of debate inside the Fed about exactly how fast we should be easing policy. The Fed's next move depends entirely on the data. We'll get a fresh dot plot and more clarity at the next meeting on March 17th and March 18th. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.